Hello and welcome to today's LBMA Global Precious Metals Conference. Today we are going to be talking about the Global Precious Metals Conference that we did last year. We had a record-breaking number of attendees at this year's conference, 840 attendees from 46 countries and over 350 companies. So today we're delighted to have joining us Rhona O'Connell, Head of Market Analysis, EMEA and Asia from StoneX Financial Limited, James Steele, Chief Precious Metals Analyst from HSBC, and Suki Cooper, Executive Director, Precious Metals Research from Standard Chartered. So without further ado, I will hand over to Rhona to lead the webinar.
Thank you very much, Tamsin. Welcome, everybody, whether it's good morning, good afternoon, or indeed good evening, wherever you are. You're very welcome to join us, and thank you for giving us your time. I'm going to introduce Suki and Jim, or following on from Tamsin's introduction, as they were the experts who wrapped up the conference for us last week with their usual dynamic and incisive views on what had been said and the varying opinions that were running, not just from the stages, but on the sidelines of the conference as well, which I know it wasn't as cautious as last year, because last year the markets were still recalibrating themselves after the previous couple of years. This year felt much more like normal, but I think the fact that everybody's been so thirsty for actual face-to-face meetings over the last 2 or 3 years, I'm not at all surprised that we had over 800 people here this year, and there were many interesting conversations going on all over the place. So sadly, I was locked into one of said conversations right at the start of the conference, so I can't talk with any expertise about what David McWilliams and James King had to say, but I know that Suki and Jim can, so Jim's going to take up the momentum from me for now.
Thank you, Rhona, and thank you to the LBMA, and thank you for everybody for tuning in. Well, the conference kicked off with Paul Fisher, John Cullen, Ruth Kroll, all discussing the precious metals before the keynote speakers. Paul took a very global approach and discussed the inflation and global economy, particularly in historical reference to Spain, being that the conference was in Barcelona, set a nice historical tone, I think, for the beginning of the conference. John Cullen discussed tariffs and Russian supply coming out of given post-invasion of Ukraine and sanctions on Russia. And Ruth touched on one of the big themes that was repeated in the conference, which was responsible gold, and also discussed the LBMA's progress in global bar database and digitizing, and outlined sustainability strategies going forward into the mid-decade. Chairman Yu from the Shanghai Gold Exchange underlined actually the importance of Asia and China in the gold market, and struck a note for a global togetherness and the ability to work together and universality of gold. But we had 2 excellent keynote speakers, David McWilliams, formerly of the Irish Central Bank, and John King of the Financial Times. Mr. McWilliams, in a very lighthearted and yet penetrating and interesting topic, discussed the world crisis that we're facing, brought poetry into it, talking about various things, which I thought was very interesting, but summed up the zeitgeist and the suspicion of following experts, and how that had led to breakdowns in the economy and overconfidence in the past, citing, for example, the recent issues in the crypto side. And I thought his comments about central bankers not knowing and some investors investment bankers not caring was a bit whimsical and not really quite accurate. But I think we got his point about being, generally suspicious of experts. James King from the FT focused on China, fishing in muddy waters, and he really did outline the rivalry between China and the West, his expectations that China would continue to evolve and to grow, but that the economy would slow, but that the shift would come to Southeast Asia But despite that, China would remain resilient. And I think the keynote for that, for gold, is that they're likely to be a continued growing and very substantial market for bullion. Suki, I think you may have a few additions to that.
Thank you, Jim. I thought both of those keynote addresses were so interesting in different ways. The fact that David brought us back to thinking about tipping points, and that every generation thinks that the crisis that it's facing now is the biggest crisis of the time. And this made me think about different tipping points that gold faces, the same macro drivers, the same geopolitical risks that broader markets face. And the quote that he shared with us from Lenin, that there are decades where nothing happens, and then weeks where decades happen, feels like we have that same price action in gold, where we see $100 moves in quick succession and then very range-bound trading. But it also made me think about the unconventional thinking and viewing risks in a different light, or the groupthink that he brought up again that we had addressed at last year's conference. So thinking about gold's role within a portfolio, it suggests that it is a good diversifier, and for those tail risks that we cannot be prepared for, that's where we might need to be thinking about gold on a more day-to-day basis, even if it's not front and center. And then the conversation with James, I thought, was interesting when we look at the impact that China has across all of our commodities, and in gold in particular, where he talked about the fact that there are fewer alternatives, that China's economy is more robust than we think. But when they were both asked about the risk of recession, David, his response was interesting in that he said that a recession is perhaps the least of our worries, and that it's perhaps other risks, whether it's debt or whether what happens next in the Middle East, that markets should be focusing on. So that unconventional thinking is something that I've taken away from that session.
Yes, I think the cautionary tale there from both conflict with China as well as the unexpected, and how things have happened historically, and we've been led down certain paths by so-called experts, and just, you know, how applicable gold is and will continue to be.
Well, that actually ties in what Suki has just raised, and Jim's obviously followed on. That ties in quite neatly with how we kicked off with the investment session, which was led by John Reed, in the sense that recession may be the least of our worries, and it's important to think about debt. Well, recession and debt are tied into one another, in my view, and particularly, and this is something which came up in the investment session, and there was a difference of opinion, which is good because that's what makes markets, about the state of the banking system. Now, this is one that's close to my heart. It's a drum that I've been beating for some months, at least since the period of last March to May of this year, wherein one member of the panel thought that the speed and the fleetness of foot with which the Fed and the Swiss National Bank in particular had acted when we had the problems with the Silicon-based banks, or the Silicon Valley-based banks, and PacWest, and then of course the implosion of Credit Suisse on the other side of the Atlantic. There are two camps here, and obviously they were reflected in that panel. One is that the central bankers had shown how quickly and how effectively they can act, and therefore that degree of risk has to some extent been mitigated. There is another camp, and I'd love to hear what Jim and Suki think about this, into which I fall. I'm not a banking analyst, but obviously looking at the precious metals markets, all three of us have to listen to what the experts in different areas have to say. And I've read a number of banking analysts who are saying it may look as if everything's all right, but there are tensions and there are stresses underneath the surface, not least with respect to the smaller size banks, and both America and China have been cited in this instance, with respect to shoring up their balance sheets, which cascades into lending or the lack thereof, and that cascades into the mid-sized companies, which are the backbone of most economies. So tied into that, that does potentially, that does talk to recession up to a point. So I don't think that one can necessarily draw a firm divide between the two. And I'd be interested to hear what Jim and Suki think about this. So certainly, John said that he's frequently asked, why has gold held up so well? And I think that this is why I think the tone of the, I'll start again, the tone of the conversation within that panel turned to risk because risk is one of the primary things that has been holding gold up for obvious reasons. And some people say that a fair value model dictates $1,300 to $1,400 per ounce, whereas obviously we're that much higher. And
yeah, very much. And I thought that the question about refinancing debt was really important. It came up in this session because we've been dominated by inflation and equity markets and yields as far as the gold market has been concerned. But the fiscal situation and the growth in public debt, which was brought up in this session and really showed how big the financing costs are going to be going up. And then for us old timers, the name of Arthur Burns came up, head of the Fed back in the 1970s when we had rising inflation. I thought that was interesting that we would harken back to the 70s again in this panel. But I was taking some positive as far as gold was concerned from this panel about the pension allocation recommending between 2 and 3 increased from the speaker, I think, up to 3% from 2, and the BIS, Bank for International Settlements, reaffirming that they had 15% of their capital in gold, and also discussions about how international trade, whether it's up or down, can impact gold prices. Now, it was a good panel because not everybody had the same views, as you said. And once gold was described as a balloon, and which obviously deflates quickly, and of course we had the usual joke about silver from John Reed of the World Gold Council.
What I loved about this session was that we had 3 different panelists who had a very different way of including gold in their within their portfolios or within their day-to-day or within risk management. On the one end, we had a much more short-term view and looking at gold and dislocations in the market, looking at risk premiums, perhaps trading on an intraday basis a few weeks, depending on what the key themes were in the market, all the way to a pension fund that was allocating gold and that perhaps not reviewing it on a quarterly basis, but doing those big reviews every 4 to 5 years. So as you said, Jim, they had increased their allocation from 2% to 3% after the pandemic. And then we had the BIS, who talked about having that gold as supporting their balance sheet and liquidity at 15%. So even with 3 very different ways of holding gold, of being exposed to gold, there were some views that came across that were very similar. They broadly all believed that interest rates would remain higher for longer, and that validated having an exposure to gold. But they also talked about tail risks in the gold market. And Peter Zollner in particular said that when they had done some analysis, they believed that to be able to hedge or gold's optimal level in a portfolio should be anywhere between 3 to 6%. But that's before you even take into account tail risks. So one comment that was made is that it's a big relief to have an exposure to gold when the unexpected occurs, a theme that was in the keynote addresses as well. But also we had discussions around what would you use within a portfolio to diversify, and while the BIS and the pension fund comments were gold plays that role, from the perspective from a hedge fund, they said that they diversified across different risk assets. So it wasn't necessarily gold that they turned to. And I appreciated that different perspective on the role that gold can play. It can be short term, but it can also have that longer term hedge in terms of tail risks.
Yes, I think that was repeated, and again, in all fairness, although this is certainly it tends to be a pro gold audience at the LBMA in general, we did have one speaker cautioning that the fair value of gold, as Rhona pointed out, was considerably, in his view, considerably lower.
Of course, it's always interesting to try and work out exactly how people calculate fair value. Is it done on the basis of mining costs and incentive prices when it comes to the trigger to develop a greenfield or to further develop a brownfield? Does that have to be mitigated by the fact that gold itself can be, of all assets, of all hard assets, I should say, it's probably that which can be most easily mobilized, partly because of the nature of the retail sector in the Far East and anywhere east of Suez, basically. But also, of course, we have the central banks And I don't recall which one it was. I think it might have been Paul Volcker, who said, 30 odd years or so ago, that the central banks dislike a disorderly gold market more than they dislike just about anything else, and they will always stand there as lenders of last resort. Cue the conspiracy theorists, of course. But all those different elements or potential elements of supply, it befuddles me as to exactly how you do model for fair value of gold. But if people say it's $1,300, then who am I to gainsay it?
Well, if anybody figures that out, please email me, call me, Zoom me.
Exactly.
I'm all ears. I've been trying to do it for most of my adult life.
Indeed. One of the other elements of that session, and to some extent, I suppose this is testament to the fact that John was running it, as you say, Jim, from the World Gold Council. There was the question: how do we get the youngsters interested in gold again? And that, of course, leads us into something else which we will come on to talk about, which is the use of digital technology. And there are all sorts of different applications that we can discuss with respect to the gold market as a whole, but a little bit later on when we start talking about AI and so forth. But online technology does appear in some countries to be working, because certainly one panelist was talking about the fact that I think he said that something like half of the retail coin demand in Germany is supported by electronic platforms. There's certainly in places like India, you can use your phone to buy anything down to one gram or even 1 rupee's worth of gold, and youngsters are doing that on a regular basis. So there is an argument here that the use of electronic technology, I don't mean big data in this particular instance, is another way of actually marketing it. And certainly that was something that they were looking at. Particularly, no, sorry, Jim, come on.
No, very, I agree entirely. And we should remind ourselves that gold is the only commodity currency to survive into the electronic age, and doesn't show any sign of not being able to. Just shifting gears, just for a moment, if I may, we had moving from the macro really to some very technical presentations, as the PGMs always are. We had an absolutely splendid PGM session, and all female, all South African review. It was really quite splendid. With their fuel cells were discussed, and the discussions of the mega trends that would involve platinum in particular. A very sober evaluation of electric vehicles and how they were biting into PGM demand, and again with palladium being the principal victim of this, if you can put it this way, but that an underlining of the reasons for the ongoing substitution between platinum and palladium, and a discussion of recycling, which I thought was particularly interesting, because sometimes it's not talked about as much in the PGMs as I think it should be.
I agree with you. It's not talked about enough. And palladium in cars has for easily 15 years has been described as, quote, the mine on the road, which it is. It's now the second largest supplier behind.
Indeed, that's right. And some sober outlooks on the risks perhaps to BEV forecasts, that countries and governments may not be able to push through these large percentage shifts for 2030 to 2035 that has been talked about, and how fuel cells could work more for platinum, and the whole discussion of energy transition. I did think that discussion of mega cycles, as it applies particularly to platinum, and the differentiation between short-term, medium-term, and long-term demand, and how it'll affect platinum and palladium rhodium differently from each other, was also very valuable. And not to forget too the discussions that the South African industry faces, or the problems, the obstacles they face with load shedding, supply issues, and the capacity, the capital expenditure cuts, which are going to influence production going further down the cycle. A really great session.
Well, Emma made an interesting point there, where she was talking about within South Africa, the rise in her expected rise in capital expenditure over time will not be for new mines, but on adding value, which makes a lot of sense. A lot of sense. Suki, what did you get from that one?
Yeah, I really enjoyed this session because we had focus on three very different but important points. And at the start of this session, the audience was asked, "What do you think is the main driver?" And we had quite a varied view somewhere between demand and energy policy response. But what I enjoyed, particularly with Bernard's comments on the role that recycling can play, and the fact that he had an estimate that suggested that PGM demand may not have peaked, and we may actually see continued growth in demand in 2024, 2025, and then it may not come off until 2026. And then recycling could pick up the gap, but maybe not immediately, because we're starting to see vehicles on the road for a little bit longer. So that changes the supply and demand balance in the near term. But then the presentation from Marge on electrification of vehicles, I thought was fascinating when she talked about it from the perspective of policymakers being very focused on what the energy efficient solution was, rather than thinking about what the metal or the critical minerals efficient solution was. And she presented us a very different perspective, where she talked about, yes, we know that there are critical minerals that are going to be short in supply, whether it's copper, whether it's cobalt, whether it's lithium. But if we looked at the entire mix of the solution, it could be that there's not enough critical minerals to support the growth in battery electric vehicles that are being projected at the moment. But the fuel cell vehicles are underappreciated. And if we think about the availability of PGMs, it makes that profile very attractive. We know that the development of fossil fuels resulted in the use of PGMs, and as you've said, the mine on the road. This is a source of metal that can be tapped into without having to explore every inch of crust on the earth to be able to derive enough copper that you still won't have enough metal to be able to support electric vehicles. I also really liked her comments on fuel cell vehicles, and that there's a misconception that it's too expensive. And she shared that it's around about $600 for PGM usage in a vehicle, and under $1,000 for nickel and copper. But if you compared that cost to battery electric vehicles, it was at least double that. So it's a misnomer to believe that fuel cell vehicles are very expensive when it comes to the critical minerals. It's really the battery electric vehicles that are perhaps going to be more damaging in terms of the environmental impact, the society impact. But then from Emma's presentation on the supply side, I enjoyed her comments where she talked about CapEx perhaps being at its highest in 10 years, but also that we may be underestimating what the producer response could be. And it might not be that big headline, a mine is being closed down, but it could be marginal shaft closures, it could be a drop in capital expenditure. So from each of those, I took away recycling is slow now, but could speed up. There's potential more for demand. Marge talked about palladium being the thinking person's nickel, where you could see some displacement of nickel in catalysts where base metals are used. It's going to be a slow process and you need a huge market share. But Bernard disagreed with that, and he said he thought it's going to need a lot of displacement before you make up for the drop in palladium usage in ICE vehicles. And then Emma's comments on that supply constraint, I thought this was a lot of information for us to process in our supply and demand balances.
Absolutely, yes.
Yes, indeed. And there is room for a lot of thought on that. And we could see a slow bleed lower in South Africa.
Yeah, I saw a headline this morning, or maybe yesterday, Sibanye-Stillwater are already looking at, or the headlines are now through, that Sibanye-Stillwater is already looking at restructuring some of the shaft allocations. So it's already there to some extent. But yes, particularly with respect to fuel cells, and they are especially useful for the heavy duty vehicles, because certainly the efficiency of an electric car, the size of the battery is basically, it's an exponential function of the range that you need, or the other way around, and certainly the weight of the vehicle. At the moment, the current design of those batteries is such that adds significantly to the weight of the vehicle, which obviously constrains the range and so on and so forth. So if there is some trade-off between nickel and palladium, and my goodness, palladium is going to need it, then that would be very helpful, because otherwise it's
that might take up some of the slack, yeah, because we know it's going to continue to lose ground to platinum.
It is, yes. And of course, the other thing about palladium, which is similar to silver, she says, sort of nice, neat segue, because I'd like to come on to silver next, is that palladium and silver are both predominantly byproducts. So regardless of what the price of either is doing, that metal is going to keep on coming, because it's going to be a function of platinum or nickel or lead, zinc or copper, or to some extent gold. Silver, and Mike and his...
Well, I think we had, did we not have the keynote on day 2?
Okay, if you want to go that way, that's
oh no, I was just going to mention that the keynote on day 2 was about artificial intelligence. I thought it was very interesting. I thought that it certainly came from out of left field in many ways. I couldn't draw a lot of applications to precious metals, but I think the fact that the speaker was able to tie in how A1 is going to affect our lives, and how and the difference between ChatGPT and other forms of artificial intelligence certainly was something that I had never even thought about, and how one wouldn't necessarily bring their business into a library and for ChatGPT, and so that I think would have a lot of interest. Historical example of how numbers helped to win World War II, and that cybersecurity was the issue going forward. And I think this digital sustainability is probably where that had the most application for gold. I found it a fascinating topic in general, but I have to think more about how it's going to apply to precious metals in particular, which is why I wanted to mention it, to see if either of you had more applications for it.
I thought her comments that it's something that we need to look at as a tool in our toolkit was a very different way of thinking about AI, and the suggestions that it could be used around logistics or supply chain management or identification verification. I thought that was an interesting way of thinking about AI, other than being a chat function that you can read, or the large language model that she talked about, and thinking about it as an engine and as a tool. I also thought, and this comes to the Champagne roundtables that we had taken place as well, the use of AI in bar identification. And Sakila later on, we'll talk about this later, just talked about how it could be used in terms of ASM. I thought those functions are underexplored at the moment and could be a very interesting application going forward.
Yes, absolutely. Because integrity of the supply chain obviously is one of the keys to the whole system. When we're thinking specifically in terms of ESG or scrap recycling, again, to come back to what we've just been talking about, but obviously particularly with respect to gold, you can only grandfather in a certain amount. And certainly some of the conversations that I've heard across the desk at StoneX have been revolving around digitization and the use of AI or equivalent thereof in terms of making absolutely certain that the supply chain and identification, the use of blockchain and so forth will guarantee that we have total integrity from top to bottom. Because there was one thing that I picked up on when the panel was discussing ESG and so forth, was that there was one refiner who basically said, you have to trust your contacts, you have to trust your governments. No, he didn't say contacts, he said collectors. Have to trust the governments, have to trust the collectors. And this also to some extent ties in with what the AI lady, I'm never sure how to pronounce her name, is it Eileen?
Eileen?
Eileen. Both of those comments basically come down to human fallibility, because she was saying that she asked the question about how many people in the audience trust your cybersecurity people to keep you safe, and I think she wasn't terribly impressed with the response. And then she said, and you know what they regard as their biggest risk? It's you. And that applies also with what the ESG panel was saying, because basically, if a human being makes an error, which a computer might or might not, but probably shouldn't, then it's the human link in the chain all the way down the line that can cause problems. So to that extent, the more digitization, the better.
Indeed.
Well, shall we stay with ESG since we've got to that point? I know that we were talking about digitalization just now at a sort of high level. There was one person who suggested that the market is actually more forward-looking than people had thought, and that the development and the uptake of digitalization with respect to ESG is key. But then we also come on to areas about artisanal mining and so on and so forth. And what did you take away from the attitude of the panel within that one?
I thought there was a lot of positive developments, but it was highlighted there's still a lot of work to be done. And I think it's impressive the strides that have already been made. And of course, the LBMA has just launched its sustainability and responsible sourcing strategy as well. And Sakila reminded us that they've gone beyond the scope, that continuously expanding it. It now does take into account the environmental impact and looks at corruption as well. But going back to AI, like discussing how the tools of AI can be used to aid this process. But one of the comments that I thought was interesting came from Metalor, where they talked about what are the sources of the feed that you have open to you. Firstly, large-scale mining. Yes, you can verify the origin of metal, but the CO2 implications need to be looked at. And then the second option is recycled gold. And that could be more environmentally friendly, but then you're not always certain of the origin of that metal. And the third option is ASM. And this could be something where there could be an considerable impact in terms of improving people's lives as well. So there's three options, but none of them are necessarily ticking all the boxes that we want to do at the moment. And through the session, I was impressed with the strides that have been made, and the fact that the LBMA now is going to be shadowing audits, and the fact that the OECD talked about standards that it had set 10 to 12 years ago, but it's still adapting and it's still carrying out its due diligence and looking at the risk in terms of that entire supply chain. So through this session, I learned a lot about the transparency, and I learned a lot about the environmental impact. But I also learned that hip-hop quotes can be used to get our points across as well.
Indeed, yeah. And I think it was the OECD, I think, that said that the first 10 years, as you've just alluded to, were basically building the building blocks and putting in the foundations, and now we can go that little bit further and that little bit faster.
And we can learn from the PG.
Sorry, I thought some of the comments from the LBMA itself, from the legal side, was that governments have to keep leading on this, and that they have to be given direction, and that independently, we've gone a long way, but we need to be able to be guided, at least pointed towards what is expected of the industry, when is it expected, in order that we can construct a framework. And I'm glad too that there was some commercial discussion about how much is this going to cost per ounce, per bar, however you look at it, who's willing to pay for this, and in addition, of course, the massive opportunity there is in portfolio for portfolios ranging from insurance to pensions to all sorts of things, for green for companies wishing to involve in green investment. If we can convince them, that we can show them, rather, not convince, but show that this is responsible gold, then perhaps gold can be included in many more portfolios, than it is now. And that I think was really key, and that's really makes commercial sense.
Yes, absolutely. And that also came up in the panel about gold's performance in a high price environment. Because there were a couple of comments there. So certainly one, there was I think it's a question from Floor, I'm not sure, whether retail investors cared about environmental provenance. The answer came back from one person, no, at least not in India, which may or may not have been whimsical, and also that it was still early days in China, but that green gold may come to fruition. At the moment, it does seem to be very much like, well, it is a Western-led philosophy, but it is working its way right the way around by the sound of it.
I thought that was a great question to ask. On the consumer level, how many customers are asking about the provenance of metal, and how many are willing to pay that premium? And the fact that each of our panelists said not yet, but Henrik made the comment that it's most likely going to come up in the future, but it's not front and center just yet. And he did use the word yet. Yes. But that takes us also back to the silver conversation that we had on during day 2, where it was Mike Lorenzo shared with us that a third of industrial consumption is now going towards green energy. So we're seeing this shift across every single discussion that we've had, but it came up in every single session that we had as well. There was some element of touching upon ESG or sustainability.
Yes. So
yeah, I mean,
sorry, Jim, carry on.
Sorry, please go on.
No, I was just going to follow on from Suki by saying that absolutely, 5-6 years ago, ESG would have been in a pocket all of its own, but now it is permeating through the whole industry. Jim,
and that really was refreshing, because that silver session, which I found really interesting, brought up that it takes 500,000 ounces of silver, 500,000 ounces of silver for 1 gigawatt of power to be produced. The increase in photovoltaic demand alone, I think it was something like twice as much silver in an electric vehicle than in a traditional ICE. Yeah. Really, really interesting right across the board. Silver has applications and in all sorts of things that the panel was only just able to touch on, like water treatment systems and painting, wood preservatives in the tropics, et cetera, et cetera. It really is. I know that platinum has a lot of applications in this aspect, but silver even more so to a greater degree, because it's so cost effective. And I think the only negative was the continued decline in photo demand, but pretty much everybody else, and they also outlined, how big the deficits are as a percentage. Something like 400 million ounces was quoted, 405, compared to a 1.2 billion ounce market. Now, before we get too carried away with ourselves, there's a lot above ground, and at the right price, it gets mobilized. But nonetheless, I think to put everything in perspective for silver, which is sometimes is the handmaiden of the other precious metals, was really positive, I think, particularly from such an expert panel.
Yes, absolutely. Well, I think it's like baby footsteps of silver, isn't it? In the sense that you don't really notice them, and then all of a sudden there she is. Because the uses in the cars, there's lots and lots and lots of uses in each individual vehicle, and that it's micrograms sometimes. By the time you've added them all together, it's actually really quite substantial, and that will continue for sure with the electrification of the fleet. There's no doubt about that. And
Phil talked about the fact that mine supply will not be able to keep pace, and as Jim says, it's a question of what price point those stocks will be mobilized. But I thought that was also a different perspective. And I think one of the things that I took away from this is that there are some amazing developments, as you say, Rhona, in the silver space, but that doesn't necessarily mean that silver doesn't present trading opportunities over the long term. It's perhaps in the short term, there may not be something that other commodities may look more appealing, but in the longer term, there are some really interesting trends that are taking place here.
Absolutely. And as you both say, there must come a point at which there is an incentive price which will talk to primary silver mine production. One area in which I think silver supply might keep pace will be if there is sufficient development in the copper side to feed into the electrification of the vehicle fleet, then that will almost certainly bring with it some silver byproduct. How much, of course, I certainly don't have any idea as we speak. But it's not all doom and gloom on the supply side, I don't think. So that said, we are up to 45 minutes, so we can go into questions. Or is there anything else that you think we should run through that I've missed here?
Just to mention very, very quickly, just 30 seconds on the consumer demand section, some very positive views on Indian gold and silver demand going forward, but some comments about how the young and the difference between the young and the middle-aged and older people view gold, and how it has to still be marketed, and new avenues of investment have to be made in in the so-called emerging world.
Indeed.
I thought in that session the Germany comments were really interesting, and that we'd seen this decline in consumption, but there was just so many unique factors to Germany that had driven that demand lower, whether it was a change in VAT, whether it was the wealth effect, or whether it was that gold is now competing in a higher interest rate environment. That was something that I certainly took away from that session as well.
And the very last thing on the future of gold that I would just throw in before we turn to questions was the HQLA issue about how applicable that could be for gold, and how refinancing, if gold is allowed to achieve this status, how much more demand you could get from the investment community on that high quality liquid asset. And it certainly is an important thing, and the position that panel took to on the liquidity of London. And I like the one comment about gold will not be replaced. It's been around for thousands of years and will continue to be.
Absolutely right. Yes. On which note, I think that's exactly the spot where we should stop, because that sums it up perfectly, Jim. Thank you. Tamsin, do we have any questions for us?
Hello, yes, we've got one through at the moment. If anyone else does have any questions, please feel free to pop them into the Q&A function. So if you click the Q&A button on your Zoom and put your questions through there, and then we can get to those. So we've got one question through at the moment on Bitcoin. So the question is, does the panel have a view on why Bitcoin has gone well bid, and is there any correlation on the relevance to gold?
I don't have a view on why Bitcoin has done well. It's extremely volatile. What we do know is it's not a safe haven asset.
Exactly.
And what we do know is it's not a portfolio diversifier. And we also know it's not gold because it's not physical.
And we also know it's not manipulated.
I'm not saying it's going to go down. I'm not saying it's going to go up. I'm not saying I like it. I'm not saying that I don't like it. All I'm just saying is that it can't be confused or married to gold in any way, despite the popular press. And I think it's interesting. I'm very glad we got the question, but I'd also point out that we didn't have hardly any discussion on Bitcoin at the LBMA.
True.
If Rhona and Suki, if you got anything to add to that?
I agree with you entirely. It's too volatile to be regarded as a store of value. The only similarity I can see between Bitcoin or crypto, I suppose I should say, but Bitcoin obviously is the flag bearer, and gold is something which has been perpetrated by the proponents of crypto as quote stores of value, which is that it has, generally speaking, has limited supply, because the mining of it halves every 5 years or so. But that in and of itself is not enough to convince me that it's a store of value in any way, shape or form. And I might add, it's environmentally extremely unfriendly.
Actually, I should correct myself. Bitcoin or cryptos were mentioned by David McWilliams when he pointed to the explosion in FTX and what happens when young, brilliant, and competent people get their hands on a lot of money.
Read it.
I'm none of those things, by the way.
Suki, you've gone
You're on
mute.
mute, Suki.
I think the investors in the space are are motivated in two very different ways, or whether you're looking for something to diversify and stabilize a portfolio versus something with short-term, high volatility opportunities. So I think you're looking at two very different motives in the space. But also just thinking about the conference and the references to cryptocurrency, I think that it didn't crop up anywhere near as much as what we had a couple of years ago. And so I think it's started to deviate.
One last takeaway from the conference too that we didn't touch on that I just want to mention if we don't get another question is the sober how sober the conference was in regards to geopolitical events, and how although generally there was a positive tone about gold, there was some concern that geopolitical events may push the market too high temporarily, and I thought that was a very mature, very correct, very well balanced way, and I picked that up almost subliminally from the conference. I don't know if you, Rhona, or you, Suki, did pick that sort of feeling up as well.
I think to some extent it's axiomatic because silver has that higher degree of volatility than gold. But potential silver investors are not necessarily the same people as gold investors, whereas you will find on the speculative end of the gold investment spectrum a lot, and some longer term investors as well, they will finesse their gold positions by holding silver because of its volatility. And that can become both a vicious and a virtuous circle depending on circumstances. So yeah, I didn't pick it up specifically, I have to say, but it doesn't surprise me what you're saying.
I'm sorry if I said silver, I was mistaken. I meant to say gold.
Ah, fair enough.
Okay.
Similar application.
Yeah.
So we've. Oh, sorry, carry on, Suki.
I was just going to say with Aline's comments on the environmental impact, she also talked about AI didn't have like zero impact, that it's not something that's just floating in the air and doesn't have an impact. So that just comes back to the cryptocurrency. But I thought maybe we could, if there aren't any more questions, maybe we could finish up with the price polls and use that as a way to gauge the sentiment.
Yeah, we have had a few more questions. We may not get to all of them today, but what we can do, if anyone who we've not responded to the question, we can follow up afterwards via an email. We've got some of your names on there. So yeah, let's move to the price polls for now.
The audience was accurate in forecasting the direction last year, and this year once again we have positive directional moves across the entire complex. And it's interesting to see here that silver is expected to outperform gold, but there's more optimism around platinum. And I would share the optimism around platinum. We think that it's a market that's likely to move into deficit on a serial basis beyond 2023. But yeah, I thought it was interesting seeing positive moves across the entire complex.
Yes, absolutely. I don't know to what extent some of that is reflecting expectation of bearish expectations on the dollar, or whether it's just more a question of finally global economy starting to pick up. Obviously, America is in the vanguard and Europe's got problems. But I'd be interested to know roughly what the driving forces were behind those opinions.
I thought the silver. I mean, I thought the gold was a very accurate sort of a reflection of the way things are going. I was surprised at how strong the increase was in the silver.
Yes.
The platinum certainly fits, and the palladium seems to fit with the fundamentals, with the idea of deficits in the platinum, and at least a deficit this year in palladium. But the silver up above $25 was a surprise to me, even though we're positive on the metal.
Typically, if you're looking at a 3% increase in gold, you should be looking at between the 6 and 8% increase in silver, not 18.
one would think the correlation would have been stronger. Yes. Good point. And then perhaps this is the environmental issue filtering through again.
Yeah, could well be.
Do we have time for another question, Tamsin?
We do have one or two more questions if we've got the time for it. So there's a couple of questions on central banks. So what are your views on the continued high global central bank demand? And also another question about whether we think central banks will begin to hold silver as an asset.
I'll answer really fast and then turn over to my two hosts. We think central bank demand will be down on last year, but last year was record. Almost 1 out of every 3 ounces mined went into a central bank. There's excellent portfolio diversification reasons. Maybe a slight shift away from the dollar, not ending the dollar's position as a reserve currency, but maybe lower levels, safe haven, maybe geopolitical reasons as well. So yes, I think it's going to continue. When they start doing something, they tend to do it for multi-years. There's no likelihood of almost from a storage level for silver to be added to this. It's quite a narrow confine that central banks have to choose from. It's another reason I think they choose gold, is because it's a nice way to be out of the dollar but not commit to another currency. But no, it would take a lot of paperwork for silver to be added.
Yeah. It used to be an international currency. It isn't anymore. That's one of the reasons why it has the precious metals legacy. I don't think I can add to what Jim said. I think that sums it up perfectly.
Great point, Rhona. You're right. China and the US were both on silver standards at one time.
And India.
You learn something from Rhona every day.
Jim, you must know why the Calcutta Cup is so called.
Yes, indeed.
The Calcutta Cup, ladies and gentlemen, is the Scottish-English rugby international. And it's so cool because when India was taking the rupee off the silver standard, a lot of silver was melted down, and the Calcutta Cup was cast from rupees that were melted down in Calcutta. That's today's piece
of alternative use. New use of silver. Our views are very similar to what Jim has said. We continue to expect central banks to be net buyers, and we think that we're going to see a steady rate of increase across the official sector. But I think the World Gold Council annual reserve survey is also very telling, in that there's new motives, but some of those traditional drivers around liquidity and returns remain dominant as to why central banks are adding. But in the most recent surveys, we've seen geopolitical risks taking up a higher percentage of why central banks may wish to add to their gold reserves. So we think that's an important trend, and it was raised in the investment exposure session as one reason why there was a view that gold prices had held up as well as they had done, and that's because of the strength of the buying that we'd seen. But our view remains that we expect the official sector to continue to add.
Absolutely, and it has two positive impacts on the price. One is just the sheer physical supply-demand calculations or balance. The other is that if central banks are known around the world to be, I don't mean every central bank in the world, but if there is a global acceptance of the fact that central bankers are net gold buyers, then that means that they're sending a signal to the rest of the world about stability or otherwise. So it's psychological as well as physical.
Very good point. And a number of central banks have published papers from the policy wonks in the basement who, talking about the merits of a central bank owning gold. So that's a clue in itself. They wouldn't spend man hours looking at such things if they weren't interested.
Indeed.
Well, I think we're nearly at time. We do have one or two questions that we've not had time to get to today, but what we'll do is we'll follow up on those after the webinar. And if you are watching this webinar and replete and you have any questions, please email us at ask@lbma.org.uk and we will come back to you with answers to your questions. So just before we finish for today, I just want to highlight some of our upcoming training and events. So if we can just move to that slide. Excellent. So we have coming up next week our Introduction to Loco London and Introduction to Responsible Sourcing training courses. We still have a couple of spaces left on those. So if you're interested in those, please see our events webpage for more information. We've got the annual seminar and dinner on the 6th of December for LBMA members. And in March, we will be having our Sustainability and Responsible Sourcing Summit on the 20th to the 22nd of March, which will coincide with the LBMA annual party on the 21st of March. Also to add, we've just launched tickets for our conference in 2024, which will be in Miami on the 13th to the 15th of October in 2024. So for more information of any of those events, please visit our website, lbma.org.uk/events, or get in touch with our team. You can also view this webinar or any of our other webinars at lbma.org.uk/videos. I just want to say thank you very much to Rhona, James and Suki for joining us today and for delivering that excellent webinar. I hope everyone has a lovely day, and we will see you again soon. Thank you very much.